Valens Research, Uniform Financial Analytics.
Right, the first company that we looked at was highlighted was Activision. And one of the reasons why we highlighted Activision is if we look right here, when you're looking at this chart, and these charts I should say, this is what we call the performance and valuation prime chart. What I'm actually going to do here is I'm going to basically take this as full screen. And here, so we can actually see everything at once. So this is Activision Blizzard's performance and valuation prime chart, our PVP for short, we call it a balance. What you're looking at here is the orange bars are the distorted as reported ROAs, the distorted as reported asset growth, and this distorted as reported price to book and PE for this company. The blue bars are the uniform accounting, we call it true blue if you will, the uniform accounting adjusted returns of this business over the last 15 years, basically as far back as we have data for the company. Then these light blue bars are what analysts are forecasting right now for ROA and for asset growth based on consensus analyst estimates. Basically, we take all of the sell-side estimates and we convert them to uniform accounting. And then these white bars are what the market is pricing in right now at a $43 billion stock price for Activision Blizzard. Right now, the market, these white bars, are pricing in Activision Blizzard to basically have ROAs flat relative to where they're forecast to be the next 2 years. And then lastly, this line here, this is TSR relative to the market. What does that mean? So TSR is total shareholder return. Total shareholder return is the combined capital appreciation and dividend income an investor would receive by investing in this company. But it's not just TSR, total shareholder return, it's total shareholder return relative to the index that is the relevant comp for this. And the purpose of Activision Blizzard or any US company, we use the S&P 500. When you see this bar rising, right, this line I should say rising, means the company outperformed the market. In this case, the company was up basically was up 60% more than the market was, right? Because the TSR relative to the index went from 1 to 1.6. When it goes down, that means that the company underperformed the market, the index that's irrelevant. And what we can see here for Activision Blizzard is, right, we can see it was basically relatively flat for this period. And if we look, that makes sense on a uniform accounting basis. The uniform accounting ROAs for Activision Blizzard were actually relatively flat over that period, and the company had declining growth. Contrary to what the as reported metrics would show you, right? For Activision Blizzard, the as reported metrics would have said, hey, they're going from a negative ROA company, which by the way is hilarious because in 2008, they weren't a negative 6% ROA company, they were a 36% ROA company. But flipping from that to basically being a positive 6% company, you would have expected to see TSR take off. Why didn't it? Because the market is paying attention more to these uniform accounting metrics. Right, and then here you can see TSR started to rise in this period and has kept on rising. Why? Because ROA started to expand and the company started to grow. Right, if you think about it, the powerful tool that we have here when we look at the performance and valuation prime for Activision Blizzard is we're actually using a return, an ROA, and an asset growth in terms of the investment in the company to better understand a DCF model, a discounted cash flow model. If you think about it, free cash flow is the driver of a DCF model, right? Free cash flow, though, has two different drivers. One driver of free cash flow is how profitable a business is, if you will, the operating cash flow of the business. In our case, what we call adjusted earnings, which is really an adjusted, cleaned up cash flow number for the business. And the other side of free cash flow is how much are you investing in that business, right? Think CapEx, think acquisitions, think any investment that you would make into the business, right? That is the asset growth in this framework here. By looking at ROA and asset growth, we're actually getting a better way of understanding the cash flows this business is generating, which helps power, right? Because the market at the end of the day pays attention to the cash flows of the business. It helps us better explain why the TSR is going here and where TSR is going to go in the future if the company is going to be have upside or downside. What's interesting here when we highlight Activision Blizzard, right, is a couple things jump out. One, as we highlighted in the email invite, Activision Blizzard's ROA is massively understated. Activision Blizzard doesn't have a 7% ROA, they have a 39% ROA. But just as important as the level, what's also being misunderstood about Activision Blizzard is ROAs aren't improving right now. Right, on an as-reported basis, ROA rose from 4.6% to 6.8% in the last year. In reality, ROA fell slightly, right? And if we look at the white bars here, we can understand what is the market expecting. The market's expecting, right, what's happening here in 2019 and 2020, the company's forecasted to have ROAs continue to fall and basically stabilize at these 30% levels, somewhat in line with where they were in 2012 to 2014. And the market's basically saying, yeah, that makes sense. This company is going to have an ROA that's around 30% going forward. And the thing that's the question for you as an investor now is to say, hey, is there a reason to think the market's wrong? Do we think that Activision Blizzard is going to roll out a bunch of new games and so their ROAs are going to rise back up to here? Or do we think that because of the continued influx of other options for gaming, from everything from low end of gaming to, the Fortnites of the world, do we think that Activision Blizzard is going to be disrupted even more? In which case the company may look actually overvalued right now, even though the market is expecting ROAs to stay at historic lows. And that's the question that you have when you think about that, the Warren Buffett and the Marty Whitman questions, right? The whole entire idea of focusing on the world of companies, not arcane accounting mathematics. The goal of us here at Valence is to get you to that conversation, discussing the world of companies, as opposed to arcane mathematics faster, using graphics like this to highlight, one, how distorted the as-reported metrics are. But now once we see through those, and we're looking at the uniform accounting metrics, we can start to understand, okay, what is the reality now in terms of the returns to this business, and how can we understand if we have a divergent view from the market? So let's say, for instance, that I think that because of the fact that, Fortnite and all of the other opportunities that are out there are totally ruining Activision's business, and I think that Activision is going to grow slower than the market's forecasting, and ROAs are going to continue to fade, right? They faded from basically 50% to 25% this year in the last 3 years. Let's say that I think that they're going to get cut in half again over the next couple of years. I can use this tool, right, the embedded expectation tool, to plug in what I think my scenario should be. And then what I'm going to do is, instead of solving for the current stock price, which is what we were doing, I'm going to say, what does that mean the stock's worth? Right? If that happens to Activision Blizzard, if they continue to get destroyed by issues like that, this company still has 50% downside. Now, on the flip side, if we say, hey, based on the fact that their World of Warcraft legacy business is actually doing phenomenal in terms of driving people back to their legacy businesses, their StarCraft developments continue to be strong, and all of the first-person shooters and the Battle Royale games that they're doing are actually having a really good benefit and seeing them turn things around, and we think that returns could get back up to 2017 levels with normal growth rates. Well, if that's the case, this company is worth 40% more than it is right now at 78. Now, we at Valence, we don't have an opinion. We don't think that one of these scenarios is right and the other is wrong. The only companies that we actually ever make a call like that on are the names that are on our conviction long ID list that we've done the research on. Our goal here at Valence is to enable you to have that conversation, because we're seeing through the distorted as-reported metrics that are giving you directionally wrong signals, not just level, but directionally wrong signals for Activision Blizzard, and we can help you better understand what's going on there.
Valens Research, the world's leading source for uniform financial analytics.